The businesses in the media industries are in strong competition with each other to acquire limited resources like time or money, and they play a high risk game of appealing to audiences, diverse audiences, and achieve a maximum profit is essentially the goal of any media industry, any media company that exists today. So, hello, class. We're going to be talking today about building our economic perspective of the media. So, this is the Introduction to Media Literacy course. And one of the biggest aspects to understanding the media industry is to understand the money that drives the industry and to understand the companies that exist in our daily feeds in our daily lives. So we're going to be looking at that in a brief presentation here. So moving forward, these companies are highly recognizable from birth, and when we consider the amount of mergers and buyouts that have happened well over the last 25 years, we have studied how media businesses once were roughly around 50 smaller mid-sized companies, which have now become consolidated into what you see here today. As you see here, Disney, CBS, AT&T, News Corporation, Viacom, and Comcast, which is also known as Comcast NBC Universal, owning 90% of media content today. Now, we want to take a look at the economic perspective. And oftentimes we just consider that when we consume media, it's how much money I'm going to put forth to consume the latest movie or how many apps I already have and where can I get content without necessarily having to pay for it. When we should also consider the time factor in how these companies do a very good job of making sure that we spend enough time or a lot of time or majority of our day consuming their content. Now, this is according to Vox News. This is from a website called Redcode, which is owned by Vox News. And they put together this most recent chart of media ownership, as you can see here. The bigger circles are to indicate the amount of market cap size. So obviously you can see here that AT&T, which recently bought out Warner Media, has merged and their market cap is about $214 billion a year. And they boast several subscribers, millions of subscribers. And then the additional companies that you saw on the previous slide were Comcast, Verizon was also part of this deal to consolidate Yahoo and AOL, which was a former merger in itself. But Disney as well as Netflix have become the media conglomerates of the day. And as you can see here, their market share is pretty large when it comes to the overall media landscape. Now, what is interesting here in this chart, and we'll dive into, is that Apple, Amazon, Google, and Facebook are kind of set off to the side, but these companies, which were typically known as tech companies, are now in the media business and should be considered a media conglomerate as well. So what you're noticing here are some trends, and we're going to take a look at the learning objectives today and dive into these three main points, which are the media game of economics. We'll be looking at the characteristics of the game, and then how can we be better consumers and players of the game. So we'll be looking at a media literacy strategy and some takeaways that we can perhaps engage in and incorporate into our daily routine as we consume media. The media game of economics is obviously driven off of these stakeholders, which we also know as players, and advertisers play a huge role in influencing and persuading the content that we receive, particularly news content or entertainment content, because they are the initial drivers of it all. They provide the financing, the fiscal needs for these corporations to exist. In a free, open market society, such as the one we have here in the United States, our media system is also free. And primarily, most of the content, if not all of it, is financed by advertising dollars. So they play a huge role, as well as consumers, us. We're the ones that are deciding which company or which film studio is going to do well based on what we decide to consume, based on the national conversation, what is popular. So we also play a huge role in influencing the type of content that is part of this game. Now, media companies themselves are also huge players in the game because they are the quote unquote gatekeepers. They are the agenda setters and deciding on what gets covered or what kind of entertainment content gets put out and what kind of quality product we are receiving. So the media employees, in addition to the companies, the individuals that are doing the groundwork to ensure that they are meeting the needs of their company and the goals of their company, which are to provide a large profit at the end of the year. So the media game of economics is very complex. It derives around some additional characteristics of the game. And what we're looking for is to consider the trends that have happened. Now, what we're seeing is obviously over the last 25 years, we have seen a movement to conglomerate and to become bigger. And a company like Comcast, their goal is to compete with another giant. So the trend of consolidation, efficiency, as we see in the media side of the business, is important to consider that the media business is looking to be very complex interdependently, meaning if Comcast is going to own a large share of smaller companies, they want to make sure that they're able to utilize those subsidiaries or their smaller companies to work for them in their favor. So media synergy is one of the biggest aspects to this conversation of looking at it from an economic or business standpoint. So the characteristics of the game involve high level of efficiency, which means lower costs for developing or creating a film, for example, or broadcasting a sports event. They're looking at ways to be complex and interdependent in their smaller companies. And they're also looking at this idea of digital convergence and responding to the technology and the changes that are happening because of that, which really are how we view content or where we get our news. So there's a lot to be considered when it comes to these companies, considering how fast technology moves and how it influences the consumer and how they receive the media content. So cable cording is one big thing that they've responded to. Netflix is another thing that they responded to. COVID-19 shutdown and the movie theaters no longer being operational is another thing that they've had to adapt to. So it also involves monopolistic competition and therefore leads us to more ownership concentration. So if one small company is doing bad, the larger company can make adaptations and figure out a way to either cut the cost of that and then reallocate the funding, the resources for media products or platforms that may be more popular. So in looking at it from this approach, we can see that the media business is highly, highly competitive. And the factors that drive the trend of this concentration of ownership, meaning small companies owning lots more media content, is the fact that they can be much more efficient. You can take a news organization like Sinclair Broadcasting here in San Antonio, who owns News 4 San Antonio and Fox 29, and they can be very efficient by sharing the same maybe anchor that does the traffic in the morning. That's a small example, but there's so many other connections that you begin to see when you know that these anchors are on TNT and they're doing the sports thing at on Thursday night for the NBA. But hey, we also want that Charles Barkley figure to be on CBS doing the March Madness. So that's where you begin to see the efficiencies building and the opportunities to utilize their assets, meaning their workers, in more ways than one. So that's a benefit for them. Maximizing profits, that's what it leads to. And industry deregulation is also a factor that has led to this concentration of ownership. In 1996, the Telecommunications Act was passed, which basically allowed for telecommunications companies and sports owners to also be part of this media landscape. So you began to see that AT&T was not only able to just own telecommunications and run phone lines to people's homes, but they were also able to begin considering owning Warner Media, which most recently happened. So not only do they have AT&T fiber for your internet home, so they're not only the provider of internet, but they also are in ownership of content. That's what the 1996 Telecommunication Act allowed for. So in that, these are the reasons why we find ourselves in a situation where most of the content we consume is owned by very few but very large media companies, which we call conglomerates. So the media literacy strategy, here's the takeaway. What can we do? These are the externalities of the world. We know that most of what we consume is owned by, small companies or a small amount of companies. So what's the big deal, right? How does this matter? Well, knowing this knowledge, right? Having this knowledge allows us to understand perhaps how to be a better player, not just considering the amount of money maybe we're giving to these multi-million dollar companies, but also considering the time factor, knowing that they're going to provide countless, if not thousands upon thousands of hours of content. We can consider that it's also a time issue and how much we decide to engage in. And perhaps like me, if you're like me, you engage in perhaps too much, and sometimes you have to step away. So that's the agency part of this. The second point is have a higher expectation for an increased return on your investment. Remember, you're spending lots of time consuming this media, but what are you receiving in return? What is the output, right? What are you gaining from that? And is it worth it, right? The third thing, and I'll leave you with this, is think more about value of your media content. Think more about what value is it bringing to you. And if we consume, for example, maybe a YouTube video that teaches us how to cook something new, that may bring a lot of value to folks. And so it's important to consider that question. What and how much value is this media content bringing to you? So in short, as we return and close out, the businesses of the media industry are mentioned briefly in this video. I encourage you to continue researching as to how much Disney owns, or Viacom, or Comcast for that matter, and not just look at how much they own in their portfolio, but begin to think what might be some of the ramifications of other voices that are trying to get through and tell their story, And oftentimes it's difficult to do that when what we are able to access is owned by a very small amount of companies here. So, which leads us to what some would argue an illusion of choice and a marginalization of voices. So the businesses in the media industry are very strong. They compete with each other, but they also acquire limited resources and and big tech as well. So they play a high risk game. They lose money, but they also make lots of it in appealing to audiences, and they achieve maximum profit. That's typically their goal, is to achieve some level of profit so they can balance out their losses. So media industry is quite competitive, as you can tell. However, knowing the background of the economic approach, the economic perspective, we can now begin to see how we individually might want to approach our media diet and how much time we should be spending with it, and is it bringing us value? Thanks.